come is gonna get you, gonna knock you right on the head.
Welcome to Insights. I'm Eric. Thanks for stopping by. We're going to talk about the U.S. stock market today after the week close that we had on Friday and some of the concerns that are taking place internationally and domestically. We're going to look at whether or not the stock market is vulnerable. Some of this was really driven. We've talked about this in great detail in the economic and U.S. stock market report and report updates. If you're participating in those, I would take a look at them and review. We're going to look at some of those things here, but we're not going to dig too deep into it. Those reviews were there so that we can have a chronological discussion on the stock market and the economy and some of the things that are taking place so people can go back and review them. So I can't go into too much detail here in an open review. But this is really going to address the concept here that today's decline is similar to minor pullbacks or different cycles in the near term, such as 1994. They look like reasonable arguments, and they're convincing. But the fact is that today's setup is much different than 1994. And we're going to talk about that. And again, if you want a further discussion, go and hunt out the economic and stock market report on the reports page, and we'll talk about dividend yields and cycles in detail, and we'll talk about the economy, and we'll talk about all sorts of things. So this is just we're going to touch on that, and you can go there for further discussion. So the point is are we comparable to 1994? And as I said, it's not. And the reason why is down here in the dividend yield cycles, which is the long-term cycle section of the matrix. We have cycles that are almost -1 for 1 and 2 or shorter terms, minus 2.46. We have and minus 1.75. For those who are familiar with these cycles, the lower you go, the higher the risk is and the greater the vulnerability for the stock market. What we do follow is the mean cycles 1 through 4 and 1 through 6. We're not going to talk about the individual cycles in this review. That's more of a discussion for the reports. Minus 1.46 is where we stand today, and minus 1.49. When we take a look at these charts in detail, and we can see them if you click it here or you click this link inside the matrix, if you are a subscriber, you're going to pull up these charts right here. And it's clear, and I've marked 1994, and this is really not a criticism of these observations. I've heard a lot of people say, it's similar to 1994, or it's similar to the last interest rate session where the Fed started hiking interest rates. And the fact is it's perhaps, but the market is a lot different. The only thing that they have in common is the Fed is likely going to start to hike interest rates, long overdue, but the backdrop is much different. In 1994, the dividend yield cycle 1 through 4 was right about here. Today, we are just bouncing off the lowest reading that we've ever seen in 2020 and 2021, and we just came off of that. As the market starts the thing is the market's starting to turn here, so as it's turning, it's relieving some of that position. But this reading was so low. It was lower than 1929. It was lower than 1986 and 87. It was lower than 1998 and 2000 before the market then turned over again. This is a dangerous setup, a setup that some people compared to 1929 when we got down, and then we got down right there. But it's not quite that either. It was actually deeper than that. And what the dividend yield cycles are is they're a reflection of time and relative to the fundamental payouts that the S&P 500 distributes. This goes back a while. Dividend yields can be taken back into, think, 1825-ish if you use the railroad stocks. Until then, you can get it as far back as the S&P, I think, to 1850. And so what the computers recognize is the oscillation between an overvalued market, which is down around the red line and the black line here, to a undervalued market, which is above here, this green line above here, and this double set of lines here. You can see Great entry points were 1932, 1917, 1982, 74, 2009, and etc. Even 2020 popped up above the line briefly and gave us a great entry point, but we quickly relieved that as the market went straight up, and the fundamentals have not caught up, and there lies the problem. So comparing this to 1994, first of all, we're coming from a completely different situation. It would be more comparable to 1998, and it would be more comparable to 1987 in nearer term, and that would be the last two observations that would be comparable today. You can make a case for some of these down here, 29, 1959, 55, 1972, but it's really a rare reading. This is the 1 through 4 mean. When you take even longer term cycles, you can see how disturbing the current setup is. This is 1 through 6. We don't talk about this too much. Talked about it in the reports, but this reading was one of the lowest that we've seen, only comparable through 97, 98, and 1929. And when you get these readings from these levels here, way down here, once they start to relieve themselves, you run the risk of the market that's going to continue to track higher until it tries to make some type of high. In 86, we pushed up higher as the stock market declined, and then it grinded until I think it was about 1990 was right about here. The fact that we've just bounced off the low means that we're headed towards this dotted line to some degree. It's not going to be this year, it could be several years from now, it could be 10 years from now. The point is this could represent a major inflection point, and it can represent, if the market tries to replicate a 1929 style of setup, the stock market can go higher from here. And again, we talk about that more in the report discussion. But the fact is I'm more worried about a setup that would be similar to 1986 and 87, of which we get a reprieve, a bounce here into a sharp decline, and then it would continue downward again, where the market makes an ultimate peak out in here, which would probably be another, well, from this point in time, it would be maybe about another 10 years out or the end of the decade. Those are all possibilities, but it's really too difficult to know. I think today's setup is more like 1986 and 87 than it is in 1994. In terms of suggesting that it's 1994, well, here's the problem. The debt structure of the world, which is driving the grand implosion globally, is far different. This arrow marks 1994. Today, well, in terms of that time, we were just about 200% of total credit market debt relative to GDP. And just ahead of the great liquidation during the Depression years, we reached 320 some percent. Now, we slammed above that in the Great Recession of 2008 and 2009, and we reached 400%. And if you thought that was the high water mark, well, we blew ahead of that in 2020 to 400%. The fact is that the West keeps piling on the debt, and it's much worse than it was in the Great Depression. And then when this stuff finally goes down the ski slope and implodes, or they default, or they use a greatly devalued currency in order to pay it off, these are all possibilities. This will liquidate, and we'll head back down, possibly make a higher low. But the fact is that we haven't liquidated anything similar to the Great Depression, and we are going to get another depression at some point to liquidate this. It's just a matter of how it's going to look, but we haven't liquidated anything. This is 1994. Today is 2020 to 2022. They are nothing like one another. The risks are enormously high today in comparison to 1994. Different way of looking at it is how much debt we created in 1994 to create $1 of growth. In 1994, it was still above the Great Depression levels. Today, in 2009, and where we are today, we did get lower. We got as low as 25 cents for every dollar of debt we created. We have 25 cents of economic growth. Now we've upticked from those lows a bit, and are at about 26.5 cents of economic growth for that. But since about the year 2003, we've breached the levels that were set in the Great Depression at 32 cents at the height of when the debt was being liquidated. We haven't even entered a depression yet. We are in falling like we are in a Great Depression already. when this liquidates, of course, the debt will disappear and then we'll head back higher and grind up for another devaluation round that will come for the second cycle. But again, the real message here is in 1994 is right here, 2020 is right here. They are not comparable periods whatsoever. Now, the one thing that has everyone worried is that the Federal Reserve stands ready to raise rates. Perhaps they're going to raise rates aggressively intermarket. There's an emergency meeting called on Monday to sit down and do what? I don't know, talk about the Super Bowl, or maybe they're going to be talking about what's going on in the world outside of the Super Bowl, most likely. There's an aggressive intermarket meeting uh, increase. It's going to be an unusual one because what this chart right down here tells us is that the balance sheet, and marked here by red, continues to expand. It's amazing that the Fed's actually going to lower interest rates, or raise interest rates, sorry, not lower them. They're going to raise interest rates. They're going to have to because the market is pushing it to do that already. The U.S. is going to have to decide who they want to save. They're going to save the European economy, or they're going to save the United States, and UK is going to have to make that decision too. At some point, self-preservation is going to rule over, and that's why the Fed's going to start to raise rates. Begrudgingly, yes, but it's going to come at a time when the balance sheet is still expanding. So this has never really happened before, and it's astronomical levels. But granted, usually what's happening, the Fed is not bailing out the system as it raises interest rates, and that's what it's currently doing. So I find that extremely disturbing, and I will also suggest that that's why this is not 1994. The other thing we'll leave out before I end this is the velocity of money continues to fall, like we're in the Great Depression, much lower levels than the Great Depression. Yes, we are, the economy is increasing, but we are creating more money than the economy can handle. That's what the velocity of money is. It's the annual nominal GDP relative to the money supply, and that continues to fall. Now, what will happen is when the system and confidence, which continues to falter, and we are in a bear phase of confidence, again, you probably want to go and consult the economic or economy and stock report, and we talk about that there too. It's in a bear phase, and when we get complete rejection of the system, the velocity of money will turn this way. They won't be able to create it. People won't want the currency to begin with. They'll turn it over as fast as possible, and this number will start to rise. It tells us that the core economy is still intact in the United States. It's this place of a safe haven. It's one of the reasons why the dollar was bid in during Friday's unexpected news, I guess. But anytime there's a risk-off discussion, the dollar rallies. That means the core is still safe. The velocity of money will continue to decline as we go through that. But as we reach the transition point, and the U.S. economy will be challenged, and the core currency will be challenged, the velocity of money will turn higher. I suspect that at that point they will probably stop publishing the money stock figures. That's often what happens. So, but once they do, the gig is up completely at that point. But still, they're still publishing it. It's not updated as regular as it used to be. But I suspect that the velocity of money will pick up when that happens. When that does, the core economy will be challenged, and then there's a real chance for inflation and hyperinflation. So bottom line, the reason we generated this is that try not to be convinced that today's setup is somehow an experience of the latest two outcomes, interest rate hiking cycles, 1994 being in mind. It's nothing like that. I wouldn't even say this is similar to 1987, other than the risks within the dividend yield cycles are comparable to 86 and 87. So be careful that it is possible you could have an elevator shaft style decline in equities that mimics 1987, but it'll be for completely different reasons. If you have any questions, let us know. If not, keep an eye on a lot of these inside the matrix, which the matrix requires a subscription, and there's many reports on these subjects from varying topics. Everything that we cover inside the matrix, we generally make a report on stuff that's really making an impact out there immediately. Right, there's agricultural commodities, and there's silver and Bitcoin we talk about. But the U.S. Economy and stock report is an ongoing discussion. I think it's going to be really important because 2022, as we've said many times, is going to be a difficult year, and you're probably going to require the help of the matrix to get through it. And we're going to talk about it every chance we get. So thanks for watching, and enjoy yourself this weekend.